Okay, let's dive right into this explainer. Today, we're looking at a truly fascinating move in the semiconductor space. If you follow this industry, you know the radio frequency, or RF, chip market is, well, it's basically a knife fight. It's incredibly brutal, and it is incredibly rare for a major tech company to just look at a high-volume market and voluntarily walk away. But that's exactly what Qorvo is doing. They are pulling off this wild, calculated pivot away from low-margin products and driving straight toward a blockbuster $22 billion merger with Skyworks. So how on earth are they engineering this massive transition? We're going to break it all down using the raw numbers straight from their latest financials.
Here is our roadmap. First, we'll get a baseline on their financial health. Then, we'll explore this deliberate pivot, shrinking their mobile footprint while growing defense. Next, we'll unpack the massive margin transformation that's driving all of this. And finally, we'll break down the Skyworks acquisition itself, along with the very real roadblocks standing in its way. Let's get to it. Section 1, the financial health baseline. Look, before any company can successfully execute a massive, super risky strategic pivot, the underlying foundation has to be absolutely rock solid. So let's take Qorvo's financial pulse. To start, their Altman Z-score currently sits at a very healthy 3.17. Now, if you're newer to financial modeling, just think of the Z-score like a company's financial blood pressure. It basically mixes profitability, leverage, and asset efficiency to predict bankruptcy risk. Anything over a 299 puts a company firmly in the safe zone. So at 3.17, which is largely driven by their strong market cap relative to liabilities, Qorvo is operating completely free and clear of any immediate financial distress. But they didn't just pass their financial physical, they kind of aced it. They scored an 8 out of 9 on the Petrovsky F score. This is a super rigorous 9-point test of overall financial health. Hitting an 8 means their cash flow, their earnings quality, and their operating efficiency are all incredibly robust. In plain English, it means their profits aren't just accounting magic. They are backed by cold, hard cash. In fact, for every single dollar of reported net income, they generate $2.39 in actual operating cash flow. Bringing this baseline all together, we're looking at a low debt-to-equity ratio of just 0.46. They're absolutely not over-leveraged or drowning in interest. They're also pumping out a massive $679.6 million in free cash flow, giving them a really healthy 18.5% free cash flow margin. Toss in a current ratio of 3.24, showing fantastic short-term liquidity, and the picture becomes crystal clear. Why does this pristine balance sheet matter to us? Because pulling off the kind of transition Qorvo is attempting requires a massive financial safety net. And Qorvo, well, they've got exactly that. Which brings us to Section 2, shrinking mobile, growing defense. Let's actually get into the strategy here, because this is where things get genuinely surprising. Normally, right, when a publicly traded company sees its top-line revenue shrink by 1.1%, Wall Street loses its mind. Total panic. But Qorvo is executing this fascinating shrink-to-grow strategy. Management is actively and intentionally shrinking their lower-tier Android business. They're essentially pruning the deadweight, deliberately walking away from lower-quality revenue so they can focus on far more profitable areas. It's ironic, but for a tech company, deciding to sell less of something is actually exactly where they want to be right now. When you break down the fourth quarter revenue for fiscal year 2026, the split between their divisions is just striking. The mobile group, the side dealing with everyday Androids, known as the Advanced Cellular Group, dropped nearly 12% year over year. That's about $68 million gone in a single quarter. Meanwhile, their defense and industrial segment, high-performance analog, surged nearly 8% to over $202 million. What management is doing here is a ruthless, calculated trade-off. They are walking away from the grueling, low-margin smartphone volume wars in the Android space. Instead, they are doubling down on what they actually do best, securing really lucrative, sticky, multi-year contracts in aerospace, defense, and industrial applications. It is a complete shift in their corporate identity. So what's the secret weapon letting them win these massive defense contracts? It all comes down to their proprietary bulk acoustic wave and surface acoustic wave filters, mixed with some incredible gallium nitride solutions for 5G. And because they handle all of this manufacturing in-house with US-based vertical integration, they can actually shrink these radio frequency components by about 30%. If you're building a next-gen fighter jet, a satellite, or even a premium flagship phone, space is literally your most valuable real estate. Qorvo gives that space back to the engineers, and buyers absolutely love them for it. Moving on to Section 3. The margin transformation. Because, look, all this high-tech engineering and strategic maneuvering sounds amazing in theory, but does it actually translate into profit? Let's look at the bottom line. If you dig into their Q4 earnings release, one specific number practically jumps right off the page. Their non-GAAP gross margin hit an incredible 52.6%. Just think about that for a second. Despite the drop in overall mobile revenue we were just talking about, they expanded their gross margin by a massive 670 basis points year over year. That single metric is the smoking gun proving this controversial shrink-to-grow thesis is working exactly as intended. In segment by segment, the logic of this whole pivot becomes undeniable. The defense-heavy high-performance analog segment operates at a massive 34.7% operating margin. It makes the mobile segment's 25.5% look pretty anemic by comparison, right? The math here is simple, and it's brutal. Every dollar they shift out of the everyday mobile market and into defense drops significantly more pure profit straight to the bottom line.
And CEO Bob Brugerworth, he isn't backing down from this strategy at all. He's actively projecting huge confidence, telling investors to expect margins to stay above that magic 50% line for the entire full fiscal year of 2027, while simultaneously pushing earnings per share towards $7. It's a bold claim, for sure, but the current momentum actually backs it up.
Which brings us to Section 4, the Skyworks merger catalyst. All of this soaring confidence leads directly to the ultimate payoff. All this careful financial engineering, the whole shrink-to-grow pivot, the massive margin expansion, it all perfectly sets the stage for one giant event, the blockbuster Skyworks merger. Now, this is not just some small acquisition. We are talking about a $22 billion seismic shift in the semiconductor industry. Under the current terms, Qorvo shareholders are set to receive $32.50 in cash per share, plus 0.96 Skyworks shares. When the dust finally settles on this thing, Qorvo shareholders will hold roughly 37% of this newly combined super entity. Just think about the sheer synergy here. Skyworks has been quietly dominating the broader market with Wi-Fi 7, Internet of Things tech, and really crucial AI server power supply design wins, all while operating at a very healthy 41% margin. You take that entire business and bolt on Qorvo's aggressive 50+% margin defense footprint and premium mobile filters, suddenly, you've created an absolute juggernaut that dominates the entire RF and analog semiconductor space. Section 5, Merger Risks and Roadblocks. Because, hold on a second, as with literally any mega merger in the semiconductor industry, this monumental deal is far, far from a sure thing. Let's look at the hurdles they still have to clear. For one, this isn't happening overnight. The timeline stretches out to a target close in early 2027. That is an incredibly long, very tense waiting game. The combined company faces intense regulatory scrutiny, which, to be fair, is par for the course for a $22 billion chip merger. But they also have to navigate fierce pushback from activist investor groups like Starboard Value, not to mention fighting off the usual flurry of shareholder lawsuits that always pop up to try and stall the process. And even beyond those external regulatory headaches, there is serious internal execution risk for Qorvo itself. Remember that shrink-to-grow strategy? They have to flawlessly execute a planned $300 million revenue drop in their Android business. Managing a decline like that in reality is insanely difficult. To keep the math working, the defense segment must absolutely maintain its rapid growth trajectory to offset those mobile losses. On top of that, they have to sustain those 50% margins all the way through 2027 just to justify the massive valuation Skyworks is paying for them. So, it all comes down to the multi-billion-dollar question. Can Qorvo's high-stakes, shrink-to-grow pivot actually maintain its momentum? Can they flawlessly balance sinking revenue in one division with surging margins in another, long enough to cross that merger finish line in 2027? It is going to be one heck of a high-wire act for the next few years, and you can bet we'll be watching closely. Thanks for joining me for this explainer. Keep your eyes on those margin reports, and I'll catch you next time.